Recording. What is going on, everybody? Welcome to my advanced option strategies presentation. It's gonna be a short one. We're gonna be going over a couple of option strategies that are not um, basic, right? And what I mean by that is that when you're an options trader, you have two kinds of options that you can trade. You can trade calls, you can trade puts. And more often than not, most options traders like trading single direction um, options. So if you think a stock's going to go up, you're going to buy calls. If you think a stock is going to go down, you buy puts, and that's basically it. There's a lot of people that like trading that way, but there are different ways to buy and sell options to your advantage in different environments. So that's what this class is going to be about. I've left out poor man's cover calls and some other option strategies because I want to package those in more of a theta short options class. So what we're going to go over today are debit spreads, credit spreads, collars, protective puts, iron condors, and calendar spreads. All right. And if you have any questions, make sure to type it in chat because I'll be reading chat while I give the presentation. All right. So debit spreads. A debit spread is just involving buying one option and selling another at a different strike. Typically, you're looking to buy an option closer to the money and you're looking to sell an option further from the money. The risk is what you paid for both those options, and your profit is capped at the difference between the strikes minus the debit. So what this means is if I buy, say, Google at 310, if I buy Google calls at 310 and I'm selling Google calls at 315, my max profit is the width between those strikes. And what is that profit? The width between the strikes is $5. 5 times 100 is $500. So that's the most money I can make from that spread. So we like to trade debit spreads in either a bullish environment or a bearish environment, depending on your directional bias, right? It's very similar to just buying puts or buying calls. But what debit spreads allows you to do is it allows you to buy calls and puts and be directionally biased without having as much upfront cost, right? If I go to buy a Google 310 call, that's going to cost me a decent amount of money, right? But if I end up selling a call against that long option, then my total debit for that position is going to be much smaller based on how far away I'm selling the other option out of the money. These are directional bets, like calls and puts, and they operate best in low IV environments. So what that means is, if the VIX is under 20, or if you have a stock whose implied volatility is lower, that's when you want to open up a debit spread because that will give you the best chance of profitability. People will trade debit spreads because they like having defined risk, right? You know up front how much you're going to be spending on the spread. It's a debit spread because you are spending money to open the position. And they're also used for things like earnings plays, where a direction may seem pretty clear. And then when you're also trading debit spreads, you're affected by theta a little bit less because you do have positive theta and you have negative theta offsetting each other. If you don't know what theta is, it's just the decay of an option. No matter what option you buy or sell, theta affects it in some way because that's how options operate. So debit spreads, they're very similar to buying naked long calls and long puts, but you cap your upside, but you also cap your downside in terms of how much you're spending and the total amount for the spread. And they make positions cheaper to get into. So if you want to go long on a stock, but their options are super expensive, right? Like if you're looking at like SanDisk, for instance, SanDisk options are thousands of dollars each, right? But if you wanted to go long SanDisk but not spend that much on just buying long calls, you could sell a call against it. Any questions about debit spreads before I move on? Any questions at all? You can type in chat and I'll respond. If not, we will move on to credit spreads. So credit spreads is more up my alley. It's the opposite of a debit spread. So when you go to open a credit spread, you're taking in an initial premium. So what you're doing is you're selling one option and then you're buying an option further out of the money. You receive a net credit up front, and the profit is the full credit that you get when you go to open the credit spread. The loss is capped at the spread's width minus the credit received, right? So if I'm looking now, I'm going to take an example of Google again, right? If I sell the 310 Google strike and I buy the 315 call, then my max loss is going to be that $500 minus the amount of credit that I get for opening the short portion of the credit spread. So it's going to be the 310 strike, whatever that premium is, minus the 315 premium, and then that's how much premium you're getting up front. So why do we sell credit spreads? Well, credit spreads are very similar to cash secured puts. They're very similar to naked puts, where basically people will sell options to gain upfront premium, and they do best in high implied volatility environments. This is because when implied volatility is high, you get much better premiums up front when you go to sell or open the credit spread. If the strike price is not exceeded at any point, right, your lower strike, so if Google stays below 310 on my call credit spread, then I make max profit. And then my max loss will just be the width between my strikes. So if Google somehow goes above 315, then my max loss will be that $500 minus how much premium I gained up front. They are moderately directional or neutral. And the reason why it's not as directional as a debit spread is because you don't need to get the direction correct. In fact, all you need is for the stock to be under your short call or put, right? So if Google stays under 310, I'm making max profit. That's great. If Google ends at 310, I'm still making max profit. So people like to sell credit spreads because, one, they don't have to get direction right completely, and two, it's technically covered, so you don't have to have a whole bunch of capital to cover the short put that you sell. And theta decay works in your favor when you're selling credit spreads. These are also really good for if you have an earnings event. So let's say who had an earnings that was pretty bad? Microsoft or Nvidia, right? If you have an earnings event that pushes the stock way down, right at open, implied volatility will still be fairly high and not crushed yet. That would be a good place to sell a credit spread because implied volatility is high. You had a big downsized move. So if you sell a put and buy a put, you will be getting a decent amount of credit for the risk that you're taking. Any questions on credit spreads before I move on? Any questions at all? Feel free to type in chat if you have a question. And you can do credit spreads for both calls and puts. So you have call credit spreads, put credit spreads. If you're trying to open up a put credit spread, you would just sell a put closer to the money, and then you would buy a put further out of the money. And then for a call spread, you sell the call closest to the money, and then you buy the call further for the money. So theoretically, what you could do to maximize the amount of money that you make is you sell a fairly close at the money call or put, and then you sell a way far out of the money call or put, right? But technically, right, if the move goes against you, your maximum risk is increasing. The risk. So there's more risk with spreads than covered calls and cash secured puts. So when you're thinking of risk, right, your risk itself isn't that much more than a covered call or cash secured put. So if you're thinking of risk, right, covered calls, yes, that's what STOs are. So sell to opens. There's more risk in spreads than technically covered calls. Covered calls are fairly safe. The only thing that you're losing on a covered call is your upside, right? your upside is capped. That's not technically you taking a loss. You're just missing out on further gains. And then cash secured puts, your maximum loss is technically if the stock goes to zero. Whereas with a credit spread, right, your maximum loss is where your long leg is on the credit spread. And I'm going to be logging on to my brokerage account, and we can kind of look at different examples in real time, so it makes a little bit more sense. But in terms of risk, it really comes down to how you construct and how you position the option, right? Your credit spread could be as equivalent to a cash secured put as it wants to be, right? Because your max risk is how far away your out of the money leg is, or your long leg is. Okay. When I go to sell to opens, for me specifically, I typically don't trade credit spreads or debit spreads. I'm what they call naked, where it's single leg, non-directional. So I usually sell naked puts or cash, or if you don't have portfolio margin, then that would be considered cash secured. Calls, I sometimes will sell naked calls, but more often than not, I'll sell covered calls, which is basically having 100 shares and then selling calls against it. And what that does is that allows me to collect premium up front and allow theta to eat away the contract price. So if you look at my ShowTime alerts in the free section, you'll notice that I have a lot of options that I'm selling, and a lot of those options I buy back for 50% or more of that premium, or they expire worthless, which means I get maximum gain. Do you tend to buy shares when you open the covered call, or you already have the shares? So typically I will already have the shares, or it will be part 2 of the wheel, which means I'll have a cash secured put or naked put that gets assigned, so I have to take assignment of those shares. For example, you had a sell to open on 35p iron with today's expiration, and you expired it worthless. So what did you make? So what I made was the amount of premium up front when I went to go open that option. So for any of the options that you see as gains, I try to tag the open and close together. So if you want to see where I opened it, you can just kind of click it. Go to my sell to open, and whatever that premium is, that's how much I've made. So like on the like on iron, right? I had an iron 35p that expires technically next week, that I acquired basically $160 per sell, and basically that's 160 times however many contracts I'm opening for that position. Technically, Nux, that would be true if I did sell up to $3,000 worth of premium for those positions, but in order to get that kind of premium, right, you'd have to have an outsized amount of contracts. And how do we decide how many contracts that we're opening? I decide the amount of contracts I'm opening versus my maximum notional value going to zero, right? If I have a portfolio that is $30,000 and I only want to use up to 10% of that portfolio on cash secured puts on a maximum risk basis, I might open only one cash secured put on that $30,000 account. And what that does is I'm pretty sure with decent certainty that iron, it will not go to zero, right? But I use that as a metric, as a gauge for how exposed I want to be to any one stock. Obviously, that metric can be different depending on your risk, how big of a position you ultimately want if you get assigned, right? If you're selling cash secured puts, that's one way to think about it. I also look at how much premium am I taking in for the amount of risk that I'm taking in, right? If I'm selling a cash secured put, I want to be making at least 3 to 4% on that risk, right? When I go to open a cash secured put or a credit spread, the most amount of money that I can make is the upfront premium that I'm collecting in my account. That amount of premium never goes up, right? It can only go down. And that's one of the caveats with selling options, is that your max gain is capped at the beginning, and all you can do is manage your risk to the premium that you are receiving. So when you're looking at my alerts, right, I'll open something for $160, but I'll close it for $80, giving me a total gain of $80. And you might be thinking, well, why would you want to do that when there's so much more time for that option to decay? And the reason for that is because your risk exposure to the position stays static, but your overall reward goes down. So as the option decays, the total amount of money that you could make in total from that sold option ends up going down. So it doesn't make any sense from a risk perspective to keep that risk on, right? Especially when I can reallocate and find other positions where I could have better risk to rewards. So that's why I have such a high win rate on theta, is because I'm constantly adjusting them in a way where my total risk is being managed with respect to premium. That's a good question, and one that I'm probably going to have to answer a couple more times, because it does take a little bit of a second to get used to. You get assigned at the current stock price or the put price. So if you are selling cash secured puts or naked puts, you will get assigned, even if you're 1 cent in the money, at the strike of the put, right? So if I'm selling iron puts at 35 strike, if iron goes sub 35, I will get assigned at $35. Where it gets a little more complicated is if I'm selling the iron put for, if I'm selling the 35 iron put and I'm receiving $2 for it, then my cost basis will be $33, right? So your cost basis will be less because you're taking in an initial premium, but your actual trade price will be 35. When you take 50%, do you have to give back the other half of 50 of the premium? And that is correct, right? So if I'm collecting $160 per contract, I'm technically giving back, or I'm spending, $80 to buy back that option, right? And that takes my risk off when I do that, when I go to buy back, right? Some traders, they like letting their options expire worthless, right? But there are caveats to that. Like you have gamma risk, you have the fact that your risk to reward is completely terrible at sub 80% remaining, right? So there are different styles that people like to employ, but I typically will, if an option go like today, right? I sold NBIS covered calls. I sold 4 of them, right? I sold 4 of those guys for basically $100 each, so $400. That option decayed to over 50% in one day. I'm taking that premium off. I'm taking I'm taking that premium, right? So instead of making $400, I only made $200, right? But then now going into next week, if NBIS is still bullish and it wants to push up, then I would sell another set of covered calls, so on and so forth, right? It allows me to be very flexible with my positioning. Okay, so I've been answering a lot of questions about spreads, credits, and stuff, but I want to move on to our next strategy. This is all good. These are all great questions. I love it. So, protective puts. A protective put is just buying an option on a stock that you already own. It's very equivalent to just buying a put or using a hedge. It's a fancy way of saying hedging, right? You keep all the upside of your of this kind of play, right? Say I have 100 shares of NBIS, and I think NBIS, it has this tendency to go from 115 down to 90. Maybe I want to buy a 100 put. So now that is considered a protective put. You own the stock and you buy a put against it. It's just a hedge. This is technically an advanced options strategy because, you are involving multiple things at once versus just having single leg, right? We use protective puts in high conviction long positions, but you don't have much certainty in the short term, right? NBIS has fairly good readable price action in that NBIS likes to bounce between, anywhere from 85 up into 95 and then back down to 90 and then up to 110 and above, things like that, right? So if you want to capture some of that downside movement in the short term, you would use puts. The length of that really comes down to where do you think the stock is going to go in the short term, right? By buying protective puts as a hedge, you can protect yourself against downside risk, gap down risk. With the war going on, there's a lot of potential for downside risk with weekend news, right? So we kind of use puts as a hedge. Any volatile macro events, you can use puts as a hedge against your long shares. And by having long shares and a protective put, you're giving yourself some peace of mind, right? Without having to sell your shares. So instead of like, oh, I'm in a small gain right now, and I think this has a lot of long-term potential, but I don't want to deal with the pain of the downside, you can buy a put instead of just selling your shares and having to focus on where do I want to rebuy, right? Um, so in the money puts are same price as much as your shares. So the technically the best. So when you're buying protective puts, typically you want to do it slightly out of the money, right? That gives you a decent amount of protection, right? And in the event that your shares go beyond that long put, you have the ability to exercise your put if you want to, right? You can sell your shares for more than um, that breach, right? So if I have NBIS, my cost basis is 110, let's say 110, and I think NBIS probably goes down to 100 in the near term, but I don't really want to get rid of my shares. I can buy a put at 105 because I think it's going to go down to 100. And if for whatever reason I'm not comfortable holding NBIS anymore, I can exercise the put at 105 and sell my shares at 105, um, even if the price is at 100, right? So that is the benefit of buying puts, or or technically calls, right? You could do the same kind of thing with calls, right? But it's not as typical to do that. So doubling down on your return. Yeah, so it's like, so if right right for me, I have NBIS at a share price of $100, right? For me, I could theoretically sell my NBIS shares right now for a nice profit, but then I'm kind of assuming that NBIS won't continue flying, right? If NBIS right now is at 110 and my cost basis is at 100, and I'm thinking, oh, I think in the short term it'll go down, but who knows? Maybe it'll go back up, but I don't want to miss the who knows portion of the trade, right? And NBIS ends up going to 150 next week. I'll be feeling really sad if I sell my shares in the hope that it goes down and I want to rebuy. But if I buy a protective put, it gives me flexibility to say, if the stock goes down, then I could theoretically still get out, or I could close that put for a gain, right, and hold shares. So that's when you would use protective puts. Um, your protective put will only protect as much delta as you have shares, right? If you have 100 shares of something, you have 100 deltas. So if you're going to buy a protective put, if you're buying like at the money, right, that's going to be roughly 50% or 50 delta. You're technically only covering half of the value of the shares to the downside, right? But if your put does get breached, you'll be going from 50 delta to 60, 70, 80 delta and higher. Or if you have 100 shares, you could buy 2 at the money puts or slightly out of the money puts to get you anywhere from 80 to 90 delta, so that if the stock price does go down by a couple dollars, right, then you get a good protection on all shares. I like this graph I like this thing that you posted in chat. All right. So, any questions about protective puts? Anything else on protective puts? All right. If not, we're going to go to a little bit more of an advanced strategy past that, which is the caller, which is buying protective puts and then selling a call. So what this is it's like protective puts, but now by selling a covered call, you are capping your upside. And what this does for you is when you go to sell a covered call, you gain an upfront premium, and then you can use that premium to buy your downside put. And what this is good for is if you think the stock could potentially go down, then you would have the protective put. But then if you're selling a covered call, you're basically saying, oh, you don't think the stock will go up by X amount of dollars, right? You think that the stock could go down, could go up, but I don't really know by how much, right? So in this instance, if I have NBIS at $100, I might sell the 110 covered call and I might buy the 90 put, and those two options are offsetting each other. So in my previous example, in the protective put, you're just spending X amount of dollars, like a debit, you're spending X amount of dollars to protect your downside. But now, instead of spending the X amount of dollars, it's going to be the price of your put minus the amount of premium that you collected from your call. So if you have a large unrealized stock gain that you want to protect to the downside, this is how you would do it with a caller. This strategy is best suited for stocks that are near all-time highs. Typically, all-time highs follow more all-time highs, but in this instance, right, if you want to protect your downside in the near term, you could sell a covered call well above an all-time high and then buy a put below where the current price is to kind of protect yourself. So in the event that there's earnings, macro data, the Iran war, if you want to protect any downside on stocks that are near all-time highs, this is probably how I would approach it. It has a low cost, right? Because the call that you're selling against your shares helps pay for the put in this instance. So just like the protective put, it's good for if you plan on holding the stock long term, but you're nervous for short term downside. So this helps you protect against downside. Now the biggest downside to using a caller, right, is you have the capped risk, the capped gains. Obviously, we don't like capping our gains too much, right? But this is the risk trade-off. You may not make as much unlimited money, but if in the event the stock goes down a lot, you're protecting yourself. And this is a cheaper way to protect yourself versus the protective put. Okay, so any questions on the caller? Things are about to get really complicated, so if there's anything not making any sense, it's about to get a little bit more complicated. And I'll make sure to go into my brokerage account and we can look at this in real time, kind of look at how to build certain options. All right. Oh, maybe one question, perhaps? Yeah, so I mean the collar and the protective put are one and the same. One just has an extra leg that caps upside. All right. We're going to you start using the collar ASAP. Yeah, the collar is great for anything that's at all-time highs and you want to still hold your shares and protect to the downside. All right. Now we're getting to some seriously complicated, but not really kind of stuff, right? If you're new to multi-leg options, this is this is not as complicated as it gets, but it's fairly complicated. We have the Iron Condor. An Iron Condor combines put credit spreads and call credit spreads, and you collect premium on both sides of the chain. And you profit as long as the underlying stock stays between your short legs. A great example of this would most likely be, let's see, what's been chopping around for a bit. Nvidia's been chopping around. I'm trying to think of other stocks that have been basically flat. The Iron Condor is a great way to make money in a stock market that is literally that's just ranging, right? We use Iron Condors for high IV environments. The reason for this is because with higher implied volatility, we intake more premiums because those options are more expensive when we go to sell them. If we expect the stock to be range bound within plus or minus of a certain, P&L, if it's going to go up or down, we want to know by how much. We can make money on a stock using options if the stock is ranging between, $5, $10, right? They're also good for post-earnings moves. So after a really big downside or upside move due to earnings, we can then set our Iron Condor right after that event, which would be higher implied volatility. Most of the move is already done. We should see some type of consolidation. Most advanced traders who use iron condors, they will use it on indexes. So SPX, NDX, RUT. These are all assets that work best with iron condors simply because the options chain, one, is very liquid. You want a nice liquid options chain because this is technically a four-leg option strategy. Four-leg meaning you're selling a call, you're selling a put, you're buying a call, you're buying a put. In order to get all of that filled at once, you want to make sure you have decent liquidity. So if you're doing an iron condor, I would only do iron condors on indexes or SPY or QQQ or anything with really high liquidity or a monthly option, right? So we have monthly options that expire every 40 days. I would do them on that simply because the liquidity is there to get filled out on all four legs when you go to form your option. But yeah, that's just a rule of thumb. Iron condors work great in high implied volatility environments where you get a nice range where it's not breaking out of that range. I sometimes do iron condors on SPX because it's nice money. You can make anywhere from $250 to $500 with $1,000 max risk. So for every, or maybe $1,500, right? So I'm risking $1,500 to make $500 a day. And we have a couple of people in our Discord that trade this way, and they are very profitable. So, and you don't have to take an outsized amount of risk. Your biggest loss, right? If you're looking at the profit graph, I don't know if you guys can see my mouse, but basically, your profit between your profit zone and your loss, right? Your max loss is going to be on only one side, right? A stock can't go two ways at the same time. It can only go and exceed your call side, or it can only go and exceed your put side. And for a strategy like iron condors, you can even adjust it further by, if you're looking at SPX, right, for instance, and SPX is going to range from top to bottom a certain amount. You could theoretically, if SPX is at a low, you could open the put credit spread first, wait for the stock or wait for SPX to go back to the middle of the range, and then sell the call credit spread to close out your iron condor. So that's more of an advanced way of approaching your sells for the legs on the iron condor. But if you're thinking, I'm trading NBIS at 110. I don't think NBIS goes above 115, and I don't think it goes below 105. Then maybe when NBIS opens at 112 or something close to 110, then you could say, okay, I'm going to open up my short leg at 105. I'll open my short call at 115, and those will be my short legs, and then my buy legs will be out of the money further beyond that. So it'd be 120 for the long leg and 100 for the long leg. Yeah, so the volatility in the markets that we've been seeing, especially on SPX, are paying really well because not only is the VIX high, but also the market has been fairly ranging, right? It's been a really wide range, right? But you can position yourself to capture that without taking too much risk on. Any questions about the iron condor? Any questions at all? We typically use iron condor. You can do iron condors to collect credits, and then we also have other ways that are more debit related, but that's content for a different class. All right. Oh, maybe one question. All right, yeah. This is being recorded, so I will post it on my YouTube and I'll send a link. It's a free class, right? So anyone can join and watch. All right. Now, last but not least, the most complex one that we have dealt with, not from a certain the amount of legs that it has, but from the conceptual portion of it. Right, this one is a little bit harder to understand. Right, a calendar spread is a time spread, not necessarily a strike spread. So before, on all of the other examples, we were looking at differences in strike, but now we're looking at differences in time. It involves selling a near-term option and buying a longer-term option at the same strike. So if I have, if I think NBIS is going to be 110, I'm going to be selling the 110 for expiring this week, and I will buy the 110 expiring in 45 days. And that is what is called a calendar spread. If we're expecting low volatility and we expect price to stay near our strike, then calendar spread is for you. We want, in this example at least, we want our stock to be as close to our strikes as possible when we go to sell the option and when we go to buy the option. And we basically want the stock to stay as stagnant as possible, pinned to our strike price, and that'll give us our max profit. We're selling near-term volatility, and we're keeping post-event options. So a calendar spread can be really good for if you're selling into earnings. So you could sell the short leg into earnings and then buy the long leg post earnings, and that's technically a calendar spread where you're capturing the implied volatility. It's really good for near-term high implied volatility and lower long-term implied volatility. Basically, when you have implied volatility that you think will have a lower curve, or if you think implied volatility will be lower in the future, then calendar spreads is good for you. When you want directional exposure with theta on your side, essentially, because we're selling the option, we're getting theta to work for us at the same time when we have the longer option. And the reason why we're having theta work for us is because the option that we are selling closer in expiration will have a higher theta value than the long option that we're buying at the same strike. In this example, we're looking at the max loss being the net debit, right? If the underlying moves too far away from both of our strikes in either direction, we start to lose money. So our max profit will be when the stock sits literally right where we want it on our strike. So typically you'll sell at the money for these, or typically a little bit out of or a little bit in. Basically, you're trying to pinpoint where do you think the strike price will be now and where it'll be in the future based on your long leg. Any questions on this one? This one kind of is. I don't really use calendars all that much, but they are highly profitable if managed correctly or opened correctly. And in a way, your longer dated option value is getting offset by your same strike shorter dated option, right? Because you are collecting an upfront premium that can be used to buy the long leg for this example. All right. And that's basically it. Here's our summary. We have debit spreads. They are directional. They're very similar to buying and buying calls and puts. We want to use debit spreads in low implied volatility environments. We know that our max profit is capped, which is the width between our strikes, between our long call and our short call. And our max loss is the debit that we pay for that spread. The complexity of it, not very much. It's basically the same as buying a call or buying a put, but knowing what your max risk is and capping out your max profit. Credit spreads are just the inverse of debit spreads. They are somewhat directional, but you don't have to have direction 100% of the time. They do decay over time. They love high implied volatility environments because we are going to sell options. We want to get credits for that. So a higher implied volatility means more upfront credit. And then we have the caller and protective put, which are both pretty much bullish strategies, and they can be used under most conditions or any condition really. Um, and then we have the iron condors, which we just talked about, which we want to use for a neutral environment where we think a stock will just bounce between a plus or minus of a certain amount. And we like selling iron condors in a high implied volatility environment because we are receiving a credit. Our maximum gain is the credit that we get, and our maximum loss is if one side gets breached. It's that spread minus the credit received for that max loss. And then calendar spreads, they're neutral, right? They're not really directional. They're more trying to, you use calendar spreads to pin where you think where a stock will be from point A to point B in terms of time. The IB condition, right? We're looking at high implied volatility in the near term, and we're looking for implied volatility regression in the long term. Our max profit is when the stock lands right on the strike price that we choose for our long and short option. And our max loss will be the net debit that we pay to open that calendar spread. All right. So with all that said, options are tools. Master the tool, master the market. You can define your risk before entering with most spreads, and you can match strategies to imply volatility conditions. When I say the market changes constantly, this cannot be understated, and it's true all the time. Market conditions do change, and you have to monitor what the market is doing. You have to be in tune with, am I in a high implied volatility environment, or am I in a low implied volatility environment? Is what I'm trading high implied volatility, or is it low? Is what I'm trading liquid? Are there events coming up? You have to have this awareness when trading options, no matter what, or else you're just setting yourself up to not succeed. Options are difficult. They are inherently difficult. So you want to give yourself the best chance to succeed by having the most information that you can about what you're about to trade, right? If you're trying to apply a certain option strategy to the wrong environment, you're just setting yourself up to lose. Even if you're right? I don't want to see anyone lose, but there are instances where, a play just doesn't make sense, right? From a fundamental perspective. And you have to think about, we have these option strategies that we can apply, but we want to make sure it's the right environment for it. All right? Any questions for the end of the presentation before I close the presentation out and then go to my brokerage? And we can kind of take a look at them really quickly for the next 10 minutes or so. The options chain. So I'm looking right now at Google. It's a good example. I'm looking at Google expiring in 35 days. If I want to do a debit spread, can you guys see my screen? You guys able to see? Okay, so when I want to do a debit spread, I would buy my option closer to the money. So if I'm making the assumption that Google is going to hit 315, I would buy the 315. And if I think it goes up to 315, it could potentially go past 325. Maybe I cap my gain by going 325 sell. It should let me add the leg. It's much easier on. Why won't it let me? I want to buy the 310. I want to sell the 3 vertical. Oh, that's why. Okay. I typically will only do spreads on my phone because it's easier to do. But so if I want to buy a vertical, I don't know if you guys are able to see this, but I'm buying the 315, and here I'm looking to sell the 320. This will tell me how much I owe on my net debit. So if I buy the 315, it's gonna give me, it's gonna cost me roughly $700, and then if I go to sell the 320, I'm gaining about $500. So my net debit is, it's gonna give me a net debit, which is the difference between the ask and bids here, for the buy and sell. So it'll cost me $1.73 to go long on Google, right? So you can use debit spreads to get long or short on a position directionally without having to spend an arm and a leg to do it, right? These Google calls, they're $700 a contract. But I can still go long by capping my upside and selling an option against it at the 320 strike. So my max gain here is going to be $500 per spread, but my total cost will be $173. So does that make any sense? So instead of having to spend $700 for a call on Google, I only have to spend $173, right? Much better. Okay, and the same can be said for puts. So this is actually much easier to see on Robinhood. You can just go in there and buy, just go click, click, click. Same thing on Thinkorswim Mobile. You just click, click, click. I have this on single leg for my options chain, but basically same thing, right? If I want to go short on Google, the 295 strike on Google for puts is for 35 days out is $900. But if I sell the 290 against it for $700, my net debit being $1.60, that's not a bad price to pay if you want to get short Google, right? If you are a debit spread, or if you want to get directional, but not spend a ton of money on those options, that's what I would do, right? So that's debit spreads, and this applies to basically anything. I would just go to any options chain and just play around with it and see, how much money do I stand to make if I open a debit spread? How much am I spending? How much can I make, right? So now I'm going to look at credit spreads, which is the opposite of a debit spread, where I think Google probably won't go below. For this example, I don't think Google will go below 295. Okay. If I don't think Google will go below 295, I will sell this the 295 for basically $900, and I will buy the 290 for roughly $700, and my net credit will be whatever that difference is, and it does it automatically. So I will earn $160 for this spread. I get my maximum amount of money out of the spread if Google stays above 295 or higher. Typically, I like, for credit spreads in general, I do like collecting at least 1/3 of the max loss in terms of credit, right? So if I am opening a credit spread, I typically want, for every $100 that I risk, or for every $300 I risk, I want at least $100. So for this spread, it's probably not the greatest, right? It's a $500 loss at maximum, and I'm only gaining $160 from it. So I probably wouldn't open that kind of spread. But there are ways to build your credit spread where you do have that ability. So like Google is not really a great example because the implied volatility on it's kind of meh. We're at only 35% implied volatility. But like if I go to, let's see, NBIS, what's NBIS up to? If I sell an NBIS vertical for $600, maybe I buy the 90. It's a 10-point spread. It's not great either. So I probably would have to go further into the money. Options pricing can be a little wonky because of close. But the general rule of thumb is you want to try to collect at least 1/3 of the credit. Okay. Let's see, what else we got? We have protective puts. So like if I have a bunch of QQQM shares that I want to protect, right? On this account only, I have 38 shares, so nothing too crazy. for this example, I could buy a protective put right outside the money for 600 bucks at 38 delta. That will cover all my shares for the downside risk, and that's basically all a protective put is. And then the caller would be see if it lets me. Oh, it lets me just straight up make a whole caller. That's funny. For the caller, yeah, I don't want this one. I want put. Why won't it let me? For the caller, you might have to do one leg at a time. Why won't it let me just build what I want? It's annoying. Like on Thinkorswim mobile, I can just click and be done. It doesn't just let me add. But essentially for the caller that we talked about, you would sell a call and you would buy a put, and those costs will offset. I don't know why I'm unable to do it here. I can do it on my phone so easily, so I'm kind of confused. Oh, maybe this is good. So like if I'm buying, okay, now it's just doing, oh, it's a synthetic caller. It's doing it opposite. I just want to do a regular ass caller. Why won't it let me do a regular ass caller? Am I missing something here? Anyway, if I have 500 stock, I could buy a put and I could sell a call, and basically my upside is capped and my downside is capped if I do that. And then for iron condors, we have the options chain here. All kinds of contracts that you can build out. So here on iron condors, I might be looking to sell like 30 delta puts, 30 delta calls, and then I might look to buy the 16 delta put. So like for this example, the 30 delta would be 705. Sell the 705, buy the 67.65, and then for the put side, 30 delta. I typically do this execution on my phone because it's just so much easier to do. Sell the 645, and then buy the 450. Or sorry, it's 545. So you can see here with this iron condor setup, I'm receiving basically $3,000 up front, and with this exact setup, my short legs, so the 705, which is way up here, my 705, and my short leg for the put being 545. Those would be my breach spots. So that's where I want SPX to not go beyond, and then if SPX stays between these two legs, then I get 3,000 bucks. Doesn't work out like that always, but that's iron condors. And then calendar spreads is just like if I go back to NBIS for an example, I think NBIS will be 115 a month from now, I will buy the, well, it put the long one closer, but it should be like this. Yeah, calendars can't have identical components. You're right. So if I'm doing a calendar spread, I might sell the near term April weekly, and I might buy the far term April. So I'm in this example, I'm selling the same strike 115, but I'm selling the April 2nd, which is only 20 days, and then I'm buying the 35 day, which is April 17th. So that's calendar, and we get the most value out of our spread, or our calendar spread in this instance, if NBIS pins itself to 115. That would be max profit. All right. Any questions at all before we call it?